All right, recorder is going. What we are going to do is review our risk chart. What do these graphs, what do these numbers mean? Okay, so what we see on the board here is a risk chart of the signal that we just put out, trying to buy the August 3rd, August 10th, 72.5 strike call calendar in SQ. We're trying to buy that for 38 cents. Okay, because this is an upside call calendar, we're not going to make money if the stock goes down, which you can see here. Okay, so at the bottom here, this very bottom line down here is projected P&L. That projected P&L correlates to a percent move in the stock or where the stock might move to. So in this instance, after earnings, let's say the stock goes down to 59.5-ish area right here, we're probably going to lose our entire 38-cent investment. Okay. Now our projection, based on everything that we have identified so far from a technical standpoint and fundamentally, is the stock looks pretty good to make a move higher. Mike, was that live or paper? Okay, so this P&L that we see down here, John, okay, this 38 cents negative, thank you, negative 38 cents correlates to the graph up here and this loss area right here. And you can see no matter how far down the stock goes, what is the maximum we could lose? And Booty, to your point, this is why this is risk defined. We could never lose more than our investment. Wally, Mike is just telling us that he was filled at 38 cents. It's not up on the screen here anywhere. Okay, so that is this part of the graph here correlates with this P&L or this loss right here. Okay, John, does that make sense to you? Okay, so then if we look towards the upside, which is what we believe is going, we think the move is going higher, and we identify the range, which was about 72. Okay, at least that's the projection of the expected move right now. Okay, we can see this range here that we should make, based on our projections, somewhere 50 to 57 cents, that range. That correlates that stock price right here with right up here and the profit up here. Okay, so that point correlates right to here. But then, as we discussed earlier this morning with Garmin, if the stock moves too far to the upside, we could see a potential loss. And that would be due to the loss of extrinsic value or premium. But again, the most that loss could be would be right here, the amount that we paid for the spread. So this loss here, okay, this loss right in here correlates to this area right here. Does that help you out, John? So, good question. We're projecting this on August 3rd. Okay, we can do whatever we want. We can see what it looks like tomorrow. We can see what it looks like over the weekend. We can see, if we go to next week, why does the chart look incredibly different than it did evaluating it this week. If we push the date ahead to August 6th or even August 5th, why does the chart look so much different? Well, it is more delta, but why would it be more delta, John? Why would it have more delta over the weekend than it does today or tomorrow? Nope. Booty, that is correct. The sold position, the short position, is factored out of this now because the short position expires August 3rd. So this new risk analysis is now only taking into consideration a long call that we have, not the short call. So that's why after expiration, the shape of this graph is so different than it is up to expiration. This has the short call in it. This has the short call out of it. But notice one thing. The max we can lose still remains the same. The max we could ever lose is still our investment of 38 cents. Okay? No, Dell, nobody got out at 35 cents. Stock would need to be trading up around 65 or so, maybe even a bit higher than that. We may adjust it, but no, you have not missed anything. All right? Cool. So I recorded this. I'll post it up in the room here. I'll label it as risk graph analysis. And it'll be posted up in the room here shortly. Okay? John, thank you for asking the question. Yes, Booty. What can I do for you?